Hey guys, Joseph Henson here with Henson CPA Group. We're going to talk today about something a lot of people have been messaging me about. This is year-end tax strategies every veterinary owner should know. How to maximize savings and avoid surprises for tax season. Again, I'm Joseph Henson, CPA with Henson CPA Group. I appreciate you showing up today. If you have any questions, let me know. But otherwise, we're going to go ahead and get started. Why year-end tax planning matters. Year-end is the last chance to reduce taxable income for 2025. Proper planning can save thousands of dollars in taxes, both state and federal taxes, if done the correct way. Avoid last minute stress and potential errors. If you're like a lot of business owners, you don't really worry about taxes until it's time to do your taxes. And at that point, you owe 20, 30, 40, 50, 80, 100, $150,000 in taxes. You don't know how to find that. The first thing you really want to do is review your clinic's profit and loss statement. Identify high income months and plan timing of income and expenses for those months. If your highest earning month is somewhere around September, October, a lot of folks come in because they need something for their pets, for Halloween, 4th of July, there's a lot of fireworks. You want to look at those and see if you can't match expenses to those high income months. Consider deferring income or accelerating deductible expenses. If you like to have a year-end sale, see if you can do that at the beginning of the year, a year start sale, a New Year's sale. If you have some expenses you can prepay, rent, professional fees, any kind of veterinarians that you have on contract that you want to do, utilities that you can prepay. If you can prepay $10,000 to a utility and you're on a cash basis, we can deduct that for the year. Ensure all expenses are properly categorized for maximum deductions. Have you been sponsoring a sports team and putting that as advertising? Well, that's probably not, as charitable deductions, that's probably more of an advertising expense, less of a charitable donation. Those are the one things you really want to look at to maximize. If you do $50,000 a year with charitable donations, phenomenal. There are limits to that. But if you do $50,000 worth of sponsorships or advertising, doing the exact same thing, but getting your name out there, that now becomes a tax savings. You can save anywhere from 20 to 35, 40% in tax. So on $50,000, depending on your tax bracket, you're looking at $10,000 in tax savings up to $20,000 in tax savings, depending on state and local and federal taxes. And all it is you're already doing it, but making sure you're putting it in a way that makes it deductible for you. Maximize your retirement contributions. Last week we talked about retirement. This week we're going to talk about how that helps tax planning. You want to contribute to your SEP IRA, your solo 401k, or a defined benefit plan before year end. You want to get as much into that as you can. If you're over a certain age, you can put more in for a catch up. Reduces taxable income while growing your retirement savings. If you do a traditional 401k and you put $24,000 away in a traditional, yes, it will grow and you'll be taxed when you take it out, but you save tax on that $24,000 today. So again, 20% tax bracket, if you're at $24,000, that's $4,800 in tax savings. If you're at the 40% tax bracket, you're closer to $5,600 in tax savings. Plan contribution based on clinic profitability and personal cash flow. If your clinic is profitable enough that you can do this, even if you're making $120,000, but you want to put $24,000 into a 401k traditional, up your salary, put that in. Your base is still going to be this. Your take home is still going to be roughly the same, but you want to make sure that it's not affecting your take home as well. If you need help with that, just let us know. Leverage bonus and employee strategies. Year-end bonuses can reduce taxable income if strategically timed. There is a window there where you can give a bonus, pay it out after year-end, depending on your structure, but you still get that year-end bonus deduction. Consider employee benefits such as health insurance, retirement, and other pre-tax benefits. If you have a high deductible health plan, having an HSA is a huge benefit. A dependent FSA, a cafeteria plan, can also help you. If you know you have a great insurance, but you want to put money into a medical account like an FSA, a flexible spending account, or a dependent FSA if you have it, those are options you have available. This can improve staff satisfaction while creating tax efficiency. It has been shown that at least a 401k is required. Health insurance is a second close one. Not all businesses can afford health insurance currently because of the mandates around how much you have to cover. Equipment and capital expenditures. I am not a CPA who's going to say just buy equipment to reduce your taxable income. I will say if you need equipment, doing that before year end will allow you to qualify for either a Section 179 deduction or accelerated depreciation. These would allow you to reduce taxable income for 2025. There's some pros and cons here. We typically always look at both Section 179, bonus depreciation, and regular makers 5-year, 7-year depreciation. What is the difference though? With two of those, Section 179 and bonus, you take the entire amount you're purchasing and deduct that this year. So it will limit what you do in future years. That's okay if it's necessary equipment. Don't go out and spend $100,000 on equipment you don't truly need. But if your x-ray machine is getting old, if your ultrasound machine is getting old, you need those, look and see if you can get those placed into service before December 31st. Ensure your cash flow supports your equipment purchases without stress. If you need to take out a loan for these, that makes sense, 2-3 years. As I said a couple weeks ago, make sure your loan length is not longer than the useful life of that equipment. So if it typically lasts 5 years, don't get a 6 or 7 year loan, because then when it breaks in 5 years, it feels real terrible to have to go get another loan, roll this one into it to pay for another piece of equipment that you truly won't have in 5 years. Review accounts receivable and payable. Make sure you're collecting overdue invoices to increase year-end cash flow. If someone owes you money and it's past 90 days, it gets harder and harder to collect. That's why a lot of folks end up sending these to collections. If you're staying on top of this and sending out statements and just giving folks heads up, hey, I can't service your pet, I can't do this until you pay your bill, whether that's on credit card, care credit, I don't care, but we need you to pay your bill. Prepay deductible expenses if it makes sense. Again, if you have utility bills you can pay and it makes sense, say you're on a level plan for $1,000 a month, does it hurt to go ahead and prepay that? Maybe, maybe not, but it's one of those things you want to look at. Minimize unpaid balances that could affect tax planning. So anything that is going to affect your tax planning, if you owe a large amount of money to someone and you're just holding off on paying it, and this isn't on a loan, but it's on a 30 or 60 day term, but you have that. Let's say you paid a coaching person $5,000. That $5,000 this year can recognize you over $1,000 in tax savings, and that might be more beneficial as long as you see what needs to happen. Consider entity and compensation planning. You need to evaluate your S Corp reasonable compensation to optimize payroll versus distributions. What does that mean? As an S corporation, you are required to have reasonable compensation if you are actively working in the business. This isn't just, well, I'll just let it be what it is. We'll see how I really want to do this. It is a strict rule with the IRS. You have to have reasonable comp. We do reasonable comp studies all the time. If that's something you haven't done and you're not doing that yearly, reach out to us, let us know. We're happy to help you with that. Consider the timing of owner draws or distributions before year end. If you have negative basis in your company, you need to be careful. If you are very profitable though, you can start taking draws, and you should. This is something you're going to pay tax on. Taking them won't reduce the amount of taxes you pay. These are a balance sheet item, not an income statement item. Not to get too complicated, they can increase how much you pay if you took out more than you have in there with the equity, but that's another story. But you want to make sure you're doing that at strategic times. Ensure compliance while minimizing your tax burden. Document for the IRS. Common year-end tax mistakes. If you're missing retirement contribution deadlines, and you're not taking full advantage of your 401k at work, of your SEP IRA, of your solo 401, if you are the only one doing the work in the clinic, that is something you are overpaying on, especially if you're within the next 5 to 10 years of retirement. You can put away a very healthy amount. Failing to plan capital purchases strategically. Another one, if you don't strategically plan this and you end up buying the equipment in January, and that's going to help you next year, but truly you needed help for this year, that's going to be an issue. Look into October, November, December if it's needed. You don't want to buy something just because you want it unless it's truly going to help your clinic. Overlooking deductions for professional services or continuing education. If you pay us from your business, we're going to deduct that. If you are traveling for continuing education, that is deductible by your clinic. If you are the owner of your clinic, you should be getting continuing education on the clinic's dime, because not only is that a requirement to continue getting better at your job, it's also a tax deduction. So if you go on a 5-night cruise for work, for an actual continuing education event, a lot of that is tax deductible. The entertainment or meals portion is 50% deductible, but it's something you need to be aware of. Then waiting too late to review financial statements. If you aren't reviewing your financial statements monthly, if not quarterly, you need to start, because nothing is worse than getting to the end of the year and realizing I'm going to owe $50,000 in tax. I don't even have $10,000 in the bank. If that is somewhere you're at, reach out to us. Year-end tax spending can save you thousands, but only if you act before December 31st. There's a lot we can put in place today to help you for tomorrow. After December 31st, it is much more complicated. So let us help review your numbers and implement strategies for maximum savings. Again, I appreciate you guys being here. I'm Joseph Henson with Henson CPA Group. We are the veterinary financial experts. Feel free to reach out. I have a link below where you can book a call with me directly. Other than that, I will talk to you guys